Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Friday, May 8th, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. Today we were up 1.69% on the S&P 500 and closed at 2929.80. What we're looking at here is a 5-day, 5-minute chart of the S&P 500, and of course every candlestick represents 5 minutes of trading. And what we can see here, we had a pretty good week overall, and we were positive, first positive week we've had in a few weeks, and we'll look at that on another chart. But one of the patterns that we had seen over the last few days was we were gapping open very strong and then closing towards the lows of the session. We did that on Tuesday, Wednesday, and Thursday, where we gapped up, closed week, gapped up, closed week. Well, today was a much better looking day. Again, we gapped up, but then we continued to go higher and closed at the highs of the session and at the highs of the week. And as you can see, we closed just underneath the 2930 area. So overall, a very positive looking week. Now what we're looking at is a daily chart of the S&P 500. So this is a year-to-date daily chart, and of course I've overlaid the Fibonacci retracement levels. And what we can see here is we're once again trading just below this 61.8% retracement of this entire move. So the question becomes, can we continue to move up next week, or are we once again going to bump our head up against the top of this 61.8% retracement level, which is sitting right around that 2935 level on the S&P 500. So we'll have to see what next week brings, but again, pretty good looking day overall, pretty good looking week, and had a strong finish to the week. Now what we're looking at is a 6-month chart of the S&P 500, where each candlestick represents 1 week of trading, and it's a little easier to see what's been going on in the weeks when you look at it this way. So again, we had a positive close for the week. We were up 3.50% for the week, and you can see the last 2 weeks were actually negative. We were kind of going sideways, drawing a line, and this is the highest close that we've had since the 1st of March. So all of that is positive. The one thing I really didn't like about this week was we had falling volume, and we'll look at that on this chart as well as another one. You can see that this week's volume was the lowest volume week that we've had since this correction began back in the middle of February. So we're kind of getting back into an average volume range. I would much prefer to see up weeks on up volume. We'll just have to see if that is a factor going forward, but I would have much preferred to see higher volume this week, especially since we had a positive week in the first week that we've had that was positive for the last couple of weeks. Now what we're looking at is a 5-year chart of the S&P 500, where each candlestick represents 1 week of trading. And the blue line here, this is the traditional 40-week or 200-day moving average. The 40-week is equivalent to the 200-day moving average. And as you can see here on the S&P 500, we're still trading well beneath the 40-week moving average. Okay, so we still have a little ways to go, and really you're not in a true long-term uptrend until you start to trade above this 40-week moving average. So we still have a little ways to go. We're getting closer, but we're still beneath that 40-week moving average. And this lower blue line, this horizontal blue line, is where I drew the line across the top of this week's volume. And you can see over the last 5 years that the volume levels that we hit this week were pretty much average, kind of at the top end of the average range, but just more of an average volume week. And you can clearly see that this week's volume here was lower than anything we've seen during this correction. Okay, so we're getting down into more normal volume. I would much prefer to see up weeks on up volume, but we're back into more of a normal volume range, and we'll just have to see how much of an effect, if any, that has on us going forward. Now let's take a look at this same 5-year weekly chart, but let's use the DIA. For those of you guys that like to track the Dow, the DIA, of course, is the ETF that tracks the Dow 30. And what we can see here, again, we have falling volume, and we're trading well beneath the 40-week moving average. And the DIA, the ETF that tracks the Dow, trading at about where it was at the beginning of 2018. So still, again, well beneath our highs on the DIA and well beneath the 200-day, the 40-week moving average. When we move to the small caps, and this is the IJR, the small cap 600, which is one of the small cap ETFs that I like to use. And you can see here on the S&P small cap 600, we're well beneath the 40-week moving average, and we're trading about where we were back in at the tail end of 2016. So it just shows you how weak these small caps are. And when we look at the mid caps, again, the MDY is the ETF that tracks the mid caps, the S&P 400 mid caps. We're well beneath the 40-week, 200-day moving average. And you can see, again, we're trading at levels that we first hit back in 2017. So the small and mid caps are still very, very weak, and that's why I've been saying this is a very thin market. The one thing that has worked is large cap tech. Now what we're looking at is the triple Qs, the NASDAQ 100. And as you can see, the NASDAQ 100 is not quite back to its all-time highs, but it's pretty darn close, and it's well above its 40-week moving average. So this has been a very, very thin market. And what I mean by thin is we're not seeing mid caps and small caps and the Dow that are keeping pace. The large cap stuff that's more conservative. What we are seeing that's working is large cap tech, biotech. And so the triple Qs, of course, are made up of tech. There's biotech in there. And that is really what has worked since we hit the bottom on March 23rd, which so far has been the bottom. There's no way anybody knows for sure whether this is going to be the ultimate lows of this downturn. But the point is of today's session, guys, and I hope you've enjoyed this, but the point is that this is still a very weak market that's just very, very lopsided, and it's, large cap tech and biotech, which is all piled into the triple Qs, that has really worked. But when you get into a broader market measurement like the S&P 500, we're still seeing, yes, it's strengthening, but we're still way off of our all-time highs. We're still well over 14% off of our all-time highs. We're still trading beneath the 200-day moving average. And again, when you look at other things like the Dow, like small caps, like mid caps, they're even weaker than the S&P 500 is. So that's the reality of where we're at right now. Things have gotten better, but this is still a very dangerous, very fragile market. So let's not put on our party hats just yet. But the good news is things are getting better, but just still be careful because we're still not out of the woods yet. Now what we're looking at is a chart of 2018, and I have this annotated with the Simple Market Signals signals. So these are the weekly signals that come out and are published in the newsletter. And so what we can see here is the signals, the Simple Market signals are green, yellow, and red. So I'm just going to go through this very quickly. We're going to take a look at a couple of charts, but I want you to understand how these signals work and how they can help you. So first off, we have the green signal, and the green signal is the best risk-reward signal for equity investors. And what you're going to see here is that most all upward progress in the stock market is going to be made when the signal is green. And then we have the yellow signal. Now, the yellow signal indicates change, and generally what happens is after a green signal environment, then the signal will change to yellow, and if the sell-off gets bad enough, it'll change to red. Now, in this time frame here, we had both yellow and red signals. I just kind of clumped those together just to kind of give you an indication of what happens. It's very, very hard to make money in the stock market when the signal is either yellow or red, okay? So again, most all of your upward progress in the stock market is going to happen in the green signal environments. During a yellow signal, you're either going to be sideways to slightly down is kind of the realistic expectations, but oftentimes that yellow signal will be that transition signal between a green signal environment and a red signal environment. So in 2018, we went green, we were green here, and then the signal went yellow here, and then it turned red, and we'll take a look at that here in just a second. The red signal is your worst risk reward signal for equity investors, and your worst downturns, including bear markets, happen during a red signal. And we'll take a look at this here in just a second. Now, let's focus on this time frame right here where the signal went yellow, and we're going to switch to a chart that's going to straddle from September of 2018 through March of 2019, because I want you to understand what happened here. So right here, right, we had this green period, and then the signal went yellow here. And so what we're going to do is go over here. So right here is where that signal went yellow, all right? And then a few days later, the signal went red right here, and that was in October of 2018, as you can see down here. And then we had some sideways choppy movement, and then a quick sell-off. We bottomed right here in the latter part of December, and then the market started to rally. Now, a couple of things to understand is the market will bottom during the red signal, okay? Because again, remember that simple market signals, the weekly signals, measure risk levels in the stock market. So green is your best risk-reward ratio for equity investors. Red is the worst risk-reward signal for equity investors. And a yellow signal indicates that there's change, that risk is rising, and sometimes that risk gets bad enough that that signal goes red, okay? But anyway, so we bottomed here. The market started to go up, and we can see here that the signal went back to green right here. During shorter red periods, oftentimes the red signal and the green signal come out at about the same price level, okay? And I'll show you here on another chart in just a minute that the longer the sell-off, the lower that green signal is relative to where the red signal came out, and that'll make sense here in just a second. But again, this is just based on market metrics and market internals and things that go into the model, and it's about risk levels, okay? So if you get one of these quick sell-offs that rebounds very quickly, your red signal and your green signal can be in a very similar place, okay? So just understand that simple market signals measures risk in the stock market, and as you can see here, these rally attempts, right, because this was red, right, we went red here, so you get these rally attempts that fail, and then it sells off hard, rebounds pretty quickly, and then the signal goes green here, all right? Now, we're going to pick up right here, so this, again, is that transition period right here, all right? So now we're going into 2019. This is calendar year 2019 in the SP 500, again, daily charts. So this is that red period. The signal went green here. So you can see here when the market is green, this is the best risk-reward ratio for equity investors. And during the green periods, this is where most of your upward progress in the stock market is made. Let's move back and go back to 2007 through 2009, and now we're looking at weekly candles. And what I want you to understand is when the market goes into a prolonged bear market, what really happens here, okay? So now we're going back again. This is 2007. The signal, the weekly signal, when I back tested this, because remember, the model came together in 2017. I worked on this for 20 plus years to figure this out. Finally, all the components came together in 2017. So what we were looking at here, okay, what we're looking at here is actual data. These were the actual signals that the model generated in 2018 and going through 2018 to 2019 transition as we looked here, and then 2019. So this, however, is back testing. So the original red signal that came out during the bear market that started in 07 and ended at the beginning of 09 came out right here, all right? Again, around 1,500 on the S&P 500. And as you can see, we, sold off for a few months. We had this rally attempt that failed and then sold off hard again, bottomed, and the market started to rise, and the signal came out green here, all right? So this is what happens during longer sell-offs, during longer red periods. Your red signal and your green signal have a huge price differential. Just between here and here, the market was down about 40%. Now, if you lose 40%, guys, it takes 66% to get back to break even. All right, so just to get back to 1,500 after if you've got 875 left and you're trying to get back to 1,500, that is over a 66% gain that's going to be necessary to bring you back up to break even. All right, so this is where simple market signals can really, really help during all market phases. But if it can help you minimize your losses during downturns, regardless of whether it's a multi-year downturn that ends up being a super long bear market or a shorter downturn like this, if you can use the signals to help minimize your losses and maximize your gains, right, during the green periods, that is where this thing is really going to help you, okay? So the whole key here, and this is where most people get it wrong, is start with the stock market first. What is the overall market environment like? Whether you're trading the S&P 500 through, SPY or a mutual fund or whatever it is, or you're working in the Dow, or you're working in the triple Qs, or you're trading individual stocks or options, you need to get the stock market right first. What is the environment you're working in? Okay, are you in a green environment? Are you in a yellow environment? Are you in a red environment? Get the market environment right first, and then everything else becomes so much easier after that. I hope you've enjoyed today's session. Please remember to subscribe to this channel, give me a thumbs up on this video, and check out some of my other educational videos that I have on this channel. I have a lot of great market-related educational videos on this channel. Also, if you are a financial advisor or an individual investor that manages any of your own money, including in your 401k, your 403b, your IRAs, or of course your trading account, I would highly encourage you to take a serious look at Simple Market Signals, which is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about Simple Market Signals, here's some additional information. As part of the Simple Market Signals model, there are two powerful indicators. There's a risk-based indicator and a trend indicator. As a subscriber to Simple Market Signals, you will receive information on what the risk level is in the overall stock market, as well as what the trend direction is in the overall stock market. So this really, really helps. The way we disseminate the signals to our subscribers is via our weekly emailed newsletter. So within the newsletter, every weekend, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the early bird indicator, the trend direction signal on the overall U.S. stock market. You will have market and sector performance information on multiple time frames. You'll get market commentary and a weekly recap of what happened in the market. You'll have technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information in this newsletter every weekend. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There's no contracts. You can cancel anytime, and your first 2 weeks are free. Now let's recap what you get with your subscription to Simple Market Signals. You get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there is a major signal change or direction change, we're not going to wait until the weekend to get that information to you. We will send out a special midweek update when necessary to keep you up to date as to what's going on within the model. And the best fit for a subscriber for Simple Market Signals is somebody that has at least a 6 to 8 week time frame or longer. So if you're a long-term investor, you're going to love this. If you have at least a 6 to 8 week time frame that you focus on with your trading and investing, you're going to love this. If you're an ultra short-term 1 or 2 day trader, kind of a day trader, or somebody that trades within a week, Simple Market Signals might help you a little bit. But the reality is, the people that are going to benefit the most from a subscription to Simple Market Signals are those people that have at least a 6 to 8 week plus time frame that they're focusing on. And if you want even more information on Simple Market Signals and some of the strategies that you can use on the various signals, this is a very in-depth video that I will have linked in the description box below this video, along with a bunch of other videos that you may want to explore if you need additional information on Simple Market Signals before you subscribe. Also, keep in mind that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. And to subscribe to Simple Market Signals, all you have to do is go out to the website that you see here, https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that simple.